Dennis, thank you for taking the time to answer a few questions for me. Some members of our regulatory audience may be relatively new to the topic of reinsurance. So to begin our conversation, would you mind providing an overview of just what reinsurance is?
Well, first, Jim, before I get into that, I'd like to thank you and the Griffith Foundation for inviting the RAA. We found that educated regulators are the best regulators, and we're glad to be a part of this. Reinsurance is simply insurance for insurance companies. It's a voluntary transaction, but one transaction that companies find is very essential to their doing business and managing their business. It enables them to lay off a portion of the risk that they write on their own policies, transfer it to a reinsurer for a premium, and it enables them to manage their risk and solvency thereby.
And so what are some other reasons that reinsurance is used as a tool?
Ultimately, it comes down to a variety of reasons for risk transfer. You're transferring risk to stabilize your results. You want to ensure that you have a volatility taken out of your results as much as possible. You could use it to help offset the burdens of a growing book of business where conservative accounting requires expense recognition immediately. Reinsurance can help with that through a ceding commission on a proportional treaty. Catastrophe reinsurance is obviously one of the major issues that we've seen in years. It enables companies to write business and to aggregate smaller losses and cede them to a reinsurer so they're protected against hurricanes, wildfires, severe convective storms, and the like.
We have insurance solvency regulators here, so could you explain a little bit about how reinsurance might affect the solvency of insurance companies?
I think the primary issue is it protects companies when they develop an appropriate reinsurance structure. It protects them against surprises. It can avoid shock losses or large losses. If a company has a given risk appetite of X and suddenly has the opportunity to write what appears to be a profitable 2X business, by transferring some of that through reinsurance, they're able to protect both their net and their solvency. And reinsurance is a major asset for insurers, in addition to major protectant in issues such as catastrophes.
So how are reinsurers regulated? I know that they don't have the same rate and form regulation that a lot of the primary insurers do.
Well, reinsurance is a global industry, so the participants in the reinsurance market in the United States come from the US, the EU, the UK, Japan, Switzerland, Bermuda, and other places. So the primary form of reinsurance regulation is the solvency regulation of the home state or domiciled state company. In the US, reinsurers are licensed as insurers. The US recognizes some of the solvency regulators elsewhere pursuant to the covered agreement, as well as the NAIC's expansion of that to other reciprocal jurisdictions who are recognized by the NAIC and the state system as being quality regulators who are willing to share information with the NAIC. And in those situations, because they've got that information sharing, they're willing to permit the reinsurers to operate in the United States without what is called collateral, which is what you would think it is, collateral for the obligations they owe. There's also provisions in the NAIC Credit for Reinsurance Model Act, which if you don't qualify for zero collateral, there are, and particularly capital markets transactions, there is no they don't qualify because they're special purpose reinsurance vehicles. The capital markets reinsurers typically will collateralize their limit, and other carriers who don't qualify are responsible for collateralizing their reserve and claims obligations. In terms of what you said before about rates and forms, reinsurance rates are not regulated. It's a transaction between two sophisticated parties who are both insurers. And the contracts themselves are crafted to meet the needs of the parties. And there are terms that provide coverage and terms that exclude coverage, and how the reinsurance fits together relates to the appetite and risk appetite of the original ceding insurer. So that is just a manuscript contract that is drafted by the parties, and it is not subject to regulatory review.
What impact, if any, has this U.S.-EU covered agreement had on reinsurance collateral requirements?
So there's two covered agreements, one between the U.S. and the European Union, and one between the U.S. and the United Kingdom. And that says the reinsurance companies in those jurisdictions are permitted to operate on what we call a cross-border basis. That means they don't have an established presence. They're operating on a cross-border basis without posting collateral, and that's based upon a recognition of the competency of the respective regulators. That created a very positive go-forward perspective that enabled reinsurers to manage their capital better. In addition, the NAIC in the Credit for Reinsurance Model Law, the most recent revision to it, expanded from just the covered agreement reinsurers to reinsurers who are domiciled in what's called a reciprocal jurisdiction, and that's a qualified jurisdiction that has agreed with the states and NAIC for information sharing about reinsurers, and the reinsurer made certain qualifications. And in both instances, the reciprocal jurisdiction reinsurers, which includes the covered agreement reinsurers, they have to be reinsurers who have good solvency, good capitalization, and have a reputation for paying their claims.
And for public policymakers interested in learning more about reinsurance, where should they go?
My commercial is to have them attend a reinsurance seminar put on by the Reinsurance Association of America. If they come to us, we can answer any specific questions, but if they want a greater breadth of information, we do seminars on the basics of reinsurance. We do reinsurance underwriting. We do reinsurance contracts. We do reinsurance finance and reinsurance claims. And we also have what we consider the premier catastrophe modeling seminar in the world, where it's in February in Florida. It's an attractive location, and we get a number of international reinsurers and insurers coming to understand the latest information from the major catastrophe modelers. And the NAIC has recently decided to join and partner with us through their Catastrophe Modeling Center of Excellence, and we're hoping to work further with them on their ideas and our ideas, and how we can make this a better seminar for regulators themselves.
Well, thank you for visiting with me, Dennis.